It has been a long time for this, so we are having one of our investment counselors back on the show today. She hasn't been on for quite a while, so Sara will be here in a few minutes to discuss some of the current market situations, some best practices, and so forth. But before we get to Sara, a few things I really want to go over. This is really important stuff, folks. Very important. I love to point out how people get wrong perceptions from headlines and articles and the media, and how the media intentionally deceives people with headlines. And this isn't really one of those, to be exact. I was sort of making a general statement, but this is interesting because it says, I mean, look at the contradiction in this title, right? Housing inventory falls under 1 million again as sales collapse. Okay, so multiple dynamics happening here. First of all, of course, this is the NAR statistics. They include the pending home sales and the contingent home sales. I don't think that's a very accurate way to do it, but it's fine if you use that as long as you're consistent about using it to compare markets over time. That's fine. But what we're seeing here is more and more contraction in the inventory levels, less supply. And the article talks about how December was a really bad month for home buyers because there was so little to choose from. And as we've gone into January, the problem is actually getting worse, not better. Usually it gets better where there's more inventory in January because, of course, people take their houses off the market around the holidays, right? That's kind of a typical practice. But look at this. Now we have total inventory levels near all-time lows again, all-time lows, right? And we're just seeing a huge lack of supply. So for everybody who is out there thinking the market is going to crash, I think you're just going to be so disappointed and you're going to miss it. You're going to miss the opportunity here because wait till I show you another article after this one, okay? I'm going to show it to you in a moment. But I want you to see something else here. Number of consumers with new foreclosures and bankruptcies. Now, as we've talked about before, we look at the foreclosure rate over time. We look at the bankruptcy rate over time. That's obviously a signal of how homeowners and general consumers, maybe non-homeowners too, of course, are having a difficult time in a given economy. And everyone's waiting for this foreclosure rate to skyrocket, for bankruptcies to skyrocket, and it just ain't happening. Sorry to disappoint all of the chicken littles and the doomsayers. The sky is not falling, at least not yet. At least not yet. Someday it will fall, so I don't want you to think I'm saying it's, going to go on forever. But, in the country, we have like 12 people in foreclosure, like 12 of them, a dozen. A dozen people are in foreclosure in the United States. I'm obviously kidding, right? But the foreclosure rate is at historic lows, and the bankruptcy rate is at incredible historic lows. I mean, there's just like no distress like this that people are looking for. Yes, there's a lot of headlines about distress. Layoffs are increasing, but again, compared to what these tech companies that are the main source of the layoffs, they were just too fat, too gluttonous, overstaffed, with people working like, minimal amount of hours, sipping latte at the Google cafe and getting a massage after that. And they think they're working. It's a freaking joke. Okay, these people don't know what work is. And this is going to be great for them to have to learn what it's like to actually work. I can hardly wait. So we will see what it's like as these people go back to work and get real jobs, hard jobs, difficult jobs with lower salaries that are in line with companies that aren't overfunded, that the stock market didn't buy their stocks on a speculative basis on future earning projections. And, these things just get real, right? So it's good. That has to happen. That's part of alchemy. It's part of Joseph Schumpeter, my favorite economist, his creative destruction concept. And that creative destruction needs to happen in this overemployed workplace. So these aren't, and what I mean to say by that is that these aren't really like quote unquote real layoffs. They're not real layoffs. What do I mean by that? I know it sounds kind of strange to hear that, but what I mean is these are jobs that shouldn't have existed in the first place, right? They're jobs that were just the result of an overfunded stock market, venture capitalists overfunding these companies. This is, and most of the time has been, fantasy land. Ever since 1999 and the first dot-com bubble, when that was really swelling up in the late 90s, maybe before 99, but that was fantasy land. And this latest run, the last several years, has also been fantasy land. This is not reality, folks. So when you see these layoffs, they were something that was long overdue. They needed to happen a long time ago. The jobs shouldn't have existed in the first place. So that's why we've got to always ask, compared to what? And I'm just kind of comparing it to a realistic situation of employment out there. Real companies that actually make profits, that aren't overfunded by speculative stock investors and speculative venture capitalists. All right. Okay. So bankruptcies and foreclosures, very, very low. If you want to have a market crash, you got to have distressed sellers. You've heard me say that a million times. But look at this. If you believe people sell to become homeless, then you're in the group of people that have simply not read housing data for decades. Okay. Now, this is interesting. What he is saying here in this article is that when you have a constrained supply, you are going to have a sales volume problem. And we have talked about this a lot before, but in a slightly different way. He's coming at this from kind of a little bit of a different angle here. And that's why I really want to point out the way this is stated here. I have usually come at it from the angle of, look, sales are down because there's no inventory to sell. What he's saying here is that existing would-be home sellers aren't going on the market because there's nothing for them to buy, right? I mean, these are part and parcel of the same idea, but it's a little different angle on it. And that's why I really wanted to stress this. So we are going to have an ongoing supply shortage for many, many years, possibly decades to come. Now, we start to get into a population issue. And one guest that I've got coming up on this show, Neil Bawa, really good guest. I do disagree with him on the timeline, but I don't disagree with him on the overall concept. And that is the population time bomb in a declining time bomb. The great book called The Bet about Simon and Ehrlich, who in the 70s were battling over this idea of, the Malthusian idea on one side and the abundance idea on the other, the Malthusian scarcity concept. Thomas Malthus, of course, the economist who postulated that we're going to run out of everything and we got to stop having babies, right? And then the other side that says, look, people are resources, people create opportunity, they create supply, they solve problems. And that's the way I look at the world. Mostly the left side of the political spectrum looks at the world in terms of scarcity. Well, except when they spend government money they don't have, then they don't look at it as scarcity. Well, just print some more and cause some more inflation and impoverish people even more. But not us real estate investors. We will win because of inflation. We will win big. So that's the big debate, right? About the population. And the book about the population time bomb was really about too much population. But now we're coming into a situation where we're going to have too little population. And, you probably heard the interview when Elon Musk said that, many, many months ago. And he's right. Okay. But the question is, when does this wave crest? And my guest that is coming up, I got a very interesting interview coming up for you. Maybe we'll play it next week, maybe the week after. It's already recorded. It's a really good one. We go on talking about this for a long, long time. He thinks it's coming in, I think, the early 2030s. And I think it's really coming in the mid to late 2040s to 2050 in the US and other parts of the world that hit at different times, of course. But here in the US, because we've got so much immigration, not that I'm endorsing that, okay? But the fact is we have what we have, right? That really props up the housing demand and the economy a lot more than other countries do. Look, I'm on my way to Japan right after Empowered Investor Live, and I'm going to be reporting to you from Japan and really taking deeper dives into what is going on with that country. That's my second visit to Japan. Great place to visit. The people are so polite. Just such a nice culture. I'll be skiing there, and then I'll be taking another 10 days or so afterwards, just travel around Japan. Really looking forward to that because, when you are someplace, you pay more attention to it. And that the same is true with investing. When you invest in something, you pay more attention to it. You bring your A game to it rather than just sitting on the sidelines trying to study it and think, oh, well, I'm going to learn this real estate investing stuff. I'm going to learn all about it. You'll never learn as much as when you actually do it. The world belongs to those who take action, those who jump in without knowing everything and learn as they go. Life is on the job training, right? That's what life is. That's the best education you'll ever get. And the same is true with studying Japan and, being there to visit it, right? It's just a whole different concept. Going on, the lack of sellers is also a demand problem. And what we saw after June of 2022 is that sellers called it quits earlier and faster in the year than usual. In other words, they were not putting their houses up for sale, resulting in total existing home sales totaling just over 5 million units to the end of 2022. Okay. From NAR, National Association of Realtors, December was another difficult month for buyers who continue to face limited inventory and high mortgage rates, said chief economist and former guest on this show several times, Lawrence Yun. Quote, however, expect sales to pick up again soon as mortgage rates have markedly declined after peaking late last year. So little relief in mortgage rates will spur sales. But again, limited inventory will constantly be a constraint because 25% of the country, mortgages under 3% with 28 to 29 years left on those mortgages. And 65% of the country, mortgage rates on existing mortgages on their homes at 4% or lower. 65% of the homes. And they've got 28, 29 years left on those mortgages. These people are not going to want to get rid of those mortgages. They're not going to want to trade them for a mortgage that is 6% or 5.5%. Now, they might do it if mortgage rates come down a little bit, but they'll also be motivated to keep those properties somehow. And, we've discussed that ad nauseum. So let's go on. One more article here I want to share with you from Altos, okay? Latest data shows surprising home price strength. There is market resiliency in the asking prices and leading indicators for the housing market. He says, we're watching the data to roll in each week, and frankly, it keeps surprising me. This is Mike from Altos. He's been on the show a couple of times. The median price of newly listed homes is climbing. It's climbing, and price reductions continue to fall. In other words, fewer price reductions across the country more quickly than I expected. He's saying the price reductions are fizzling out and going away faster than he expected. Inventory was basically flat this week. Okay. Do these early signs of 2023 price support continue into the springtime to the peak of the market? And the spring is always the busiest time of the year. So really interesting stuff. We'll continue to watch it and report on it. Here's what he said about price reductions falling. Let's start this week with price reductions. He says in the video, the percentage of single family homes on the market that have taken a recent price cut fell again this week to only 34.7%. That's 1.1% lower than just last week. It is normal for price cuts to decline in the first quarter. Now, why is that? It's because demand picks up. New inventory gets listed. New listings don't cut prices until they sit around for a couple of months. And so the story goes. So it's going to be really interesting. Again, look, feel free to disagree with me, argue with me. If you're watching this on one of the video platforms, you can comment below. And please like and subscribe and press the notifications bell as well. And check out some of our other great videos. And if you're listening on the podcast, feel free to just go to jasonhartman.com/ask and disagree with me. right? Feel free. I learn from people who disagree with me or tell me you agree, whatever it is. I'd just love to hear your feedback on that. And I am off to our Empowered Investor Live conference by popular demand. We did go ahead and start offering live streaming tickets. Thank you to all of those who purchased your live stream pass. You can do that at empoweredinvestor.com/live or at jasonhartman.com. And if you are in the mood to just join us last minute, you can still join us. We won't have a name badge for you, but we had like 2 people just say they want to get a ticket like yesterday and attend live, and we made some room for them. No VIP tickets though, or elite tickets available, but we did work out the room seating so the hotel could put in 2 extra tables that seat 6 people, total of 6 people in those. So that is available. Of course, our cruise is coming up in just over a month. Our Caribbean cruise. This is a small group cruise. It is an Empowered Investor Pro cruise. So check that out, empoweredinvestor.com/cruise. And we will look forward to seeing you there. Okay, without further ado, let's talk to Sara, our top investment counselor. She's been working with me at a few different companies over the years for over 15 years now. And she has tremendous insights into the market and into helping investors maximize their portfolio with minimum difficulty and minimum hassles. So let's jump in and talk to Sara. It is my pleasure to welcome a guest back to the show, and we haven't had her on in a long time. Many of you know her already because she may well be your investment counselor, and that is Sara. Welcome back. How are you?
Hey, Jason, thanks for having me back. It's been a while.
It has been a while, or as the millennials like to say, it's been a minute.
Been a minute. It's definitely been a minute.
It has been a long time. And Sara, I wanted to get you back on the show because obviously the market is changing. It's doing various gyrations, and some people are just plodding along and they just keep buying properties. Some are concerned and they're kind of putting things on the sidelines. And I just wanted to start off by asking kind of what you see. You've got your ear to the ground, maybe better than anybody, and you really know what people are saying, both buyers and sellers, because you're putting those 2 parties together. So give us some insight.
Yeah, so it's kind of a mixed bag right now as far as client reaction to the market. Obviously, rates started going up at the beginning of summer or just before summer. And I would say about May, June, people started to pump the brakes. They were just really uncertain as to what prices were going to do. They were thinking, well, rates are going up and we're getting into a recession. So, there's going to be this crash. And of course, you have all these talking heads on YouTube and the news, and everybody has a different opinion, right? So it's just been a mixed bag. It definitely slowed down over the summer. And then right about end of Q3, getting into Q4, it just really picked up. Investors, realized it is what it is. And, investors always invest. So they just kept plugging away. I would say on the builder side and the seller side, there's definitely been more concessions thrown out there as far as closing costs, help with interest rate buy downs. And so investors are seeing that. They're taking advantage of it. It's a mixed every day. I talk to so many investors and, I'd say about half of them are concerned, especially like newer investors. But the seasoned investors, they get it. They understand what inflation is doing to their savings and they want to keep their money moving. And so
I should distinguish that for those who maybe didn't quite pick up on that. They understand inflation is destroying their savings. Yep. And that they've got to be in a hard asset. And even if that hard asset does not perform as well as they had hoped, it's still better than the alternative, because the question is always compared to what? Yeah.
Right. So yeah, and then I'm seeing some of our clients from way back when come back around, and a lot of our cash buyers are coming out of the woodwork. Some are making some offers on bigger portfolios, and the lenders kicking in some nice concessions towards their closing costs. So we had a client who's actually bought over 100 doors in the past 2 years, but he just closed on a 20 property portfolio last month, and he was able to lock in a 4.25, so 4.25% mortgage rate on a 3-year loan. So it's a 3-year fixed, and it adjusts in year 4. And so, he's going to see what happens over the next 3 years with rates. If they drop, he can refinance out of that loan, and then in year 4, if the rates go up, I think that I see Coco back there.
Yeah, I know. I love since I rearranged my room here, the dog sits right behind me on the little sofa there.
So cute. Tegan's under my desk.
Yeah.
So it's interesting what's going on. Everybody's got a different opinion. If you ask me, I'm not the expert on whether the market's going to crash by any means, but I just don't see how in the markets where we're doing business, which are like the more linear markets, I just don't see how there can be a big, crash. And even if there is a little bit of a downturn, most of our clients have long-term fixed rate debt on their properties, yeah, and they're actually getting better cash flow as they see their rents go up. So yeah, it's an interesting time for sure.
It is. That's the thing I mentioned to you and the other investment counselors over the summer. I remember having this conversation that in doing this as long as I have, it always feels like it's the end of the world when you're in the middle of it, right? But it never is. And all of those doom and gloomers are always wrong. They've been around forever. Think back to Thomas Malthus, who thought the world was ending in the 1700s. Okay, so, or I think it was about the 1700s, somewhere in there, and all the rest, But one of the things you always have to realize is that money doesn't sleep. People, if they rein in their horns for a while and they take a breather, that money will not keep at rest. It always comes off the sidelines. And what usually happens is, I think what we're seeing right now to some extent, it's not like the dam broke. I won't say it's anything extreme, but I'm noticing it. You mentioned our client, who I know very well. He's a great guy, just purchased 20 properties. It usually happens to where maybe the interest rates tick down just a little bit, and people kind of seize that opportunity. Maybe prices soften just a little bit. They get some concessions. Maybe it wasn't a price reduction, but it's, like you said, the seller doing a buy down or paying for some closing costs. And they just jump in. And that money that's been sitting on the sidelines for 6-7 months, it just rushes in. And we're definitely seeing that to some extent now. So that is a good thing. And people with a longer term perspective, with a mature perspective, they don't agonize over trying to time the market. They don't agonize over, oh my gosh, I should wait another year because in a year it's going to be great. But of course, what those people don't realize is in a year they're going to lose 15% of their savings to inflation, right? So, and I'm talking about the real inflation rate. They might lose 17 or 18% actually. But yeah, that's for sure.
Do we want to talk about the cost of eggs?
Yeah. Oh my gosh.
That's the joke
I love
of the
eggs
office right now.
Yeah, it's truly incredible. Eggs are the new diamond ring.
I paid $10 for 12 eggs on vacation when I went up into the mountains. Now, I think there was kind of a run on the store too, with the snow coming, but I was like, $10, when did this happen? So the purchasing power is going down every day. And you need to be in rental properties, because not only do you have that beautiful, 30-year fixed rate mortgage, but you've got the rents that are also going up with inflation, and you can't time it. You don't know when the rents are going to go up. There is going to be a lag time, so people today are like, well, $50 a month cash flow. What am I going to do with that? Or, $250 cash flow. How am I going to get rich off of that? And it's like, no, you don't really get rich off of the cash flow.
Right.
You're just preserving your wealth. And over time, some of my properties were negative cash flow when I bought them, because, the rates were higher and you could get in with less of a down payment. And so I was young and I just wanted to get in. So I got in and I took that negative cash flow for a few years, and then I refinanced, and then the rates went up. And some of my properties that were negative cash flow were like 500 a month plus cash flow, coming up on 1,000, and I'm below market. I mean, I need to raise my rents. I could be
Right.
doing probably much better. Sometimes I think I'm a little bit too nice on the, I need to take some notes from your mom on raising the rents.
Yeah, raise the rents, definitely raise them
Yeah.
to
So,
market rate. It's just so true that the uninformed think, oh my gosh, this measly cash flow, why would I bother with this, right? Why would I bother buying a property and, managing the property or managing my manager for $50 a month? But they're so uninformed because they don't understand the multidimensional nature of an income property investment and how you earn your return in so many different ways. So that's a very good point. What markets do you really like best now? Talk to us about, some of our teams in different markets that we can introduce people to and help them buy properties in these markets. And what are some of your favorites right now?
yeah, so it's kind of scattered. I guess the answer is, it depends, because with these different incentives that are coming out, that might sway me towards one market or another. Right now, I really like what we've got going on in Alabama, and we cover 3 or 4 markets in Alabama, depending on inventory. And that builder's contributing. Now, don't hold me to this, because today they're contributing.
Everything is subject to change.
Right. Today, they're contributing 6% towards your closing costs. So it could be towards your closing costs or your rate buy down. And then they've got a preferred lender, a local lender that has a 3-year arm and a 5-year arm. You can choose a 30-year fix, but if you want to get those really good rates, you can get into a 3 or a 5-year arm and get into the 4% range. So I really think that's one of the best deals we have going. Kicking in, they've got a sister company for property management. So they're also kicking in a year of covering that monthly management fee to help offset that cash flow in year one.
Yep.
We're also covering several markets in Florida. We're staying away from the cyclical markets. These are like sub-markets that will cash flow better than those cyclical markets. You got to be careful and be in the right Florida markets.
Because South Florida, where I live, is cyclical, and I would not invest here. That wouldn't make any sense. You want to invest in these linear or hybrid areas that Sarah's referring to.
Yeah, if you're in the camp of people that think there's going to be, a crash, you want to stick to the linear markets because you're going to be more risk adverse there, right?
Yeah.
So anyways, Florida, we cover, Jacksonville area, a little bit in Southwest Florida, and, centrally located like Ocala, Florida. The builders also got some nice incentives there. So they're contributing towards closing costs and helping on the property management side.
Mm-hmm. Good stuff. And what about some of our older markets that, we've been talking about for a long time? Indianapolis, Memphis, just any of the others, any Texas markets you want to mention or anything else?
Yeah, so I guess I should distinguish that those properties in Alabama and Florida are brand new. We do have relationships with existing home, they call them like, turnkey providers or rehabbers. They're in the market of buying, renovating.
The fix and flippers. Yeah, renovators.
Fix and flippers. So we still get those in Memphis, Tennessee, Kansas City, Missouri. In fact, our Kansas City, Missouri market specialist will be at our upcoming conference with some nice inventory. Jonesboro, Arkansas, we're doing a little bit of a new construction business there. I just bought one there last year, I guess a year and a half ago now. I love Jonesboro. Arkansas has just, low property taxes. And so you can get, pretty good cash flow there and a nice new construction home. So we have relationships all over. Indianapolis, we can still get deals. I will caution you though, on the fix and flip and like the turnkey stuff. The rehabs are not what they used to be. They are not really making these houses super nice to where you're getting, a brand new kitchen and, a new roof and a new HVAC. Some of them are, there are some gems out there, but that inventory, the existing home inventory is still pretty low.
Oh, it's very low. Why would someone sell a property with such a low mortgage on it? Now, the flippers don't have that long-term debt. I mean, the vast majority of the time, occasionally they do. Why do you say the rehabs aren't what they used to be? I'm curious about that. Is it just that these renovators have sort of changed their business plan overall and they're just finding it so much easier to sell the properties without fixing them a lot and, just doing a very basic improvement?
I would say over the past 2 years that statement about being able to sell them quickly is true. Now that's changed a little bit. They're not flying off the shelf like they were. But I also think it has to do with the cost of construction, and the profit margins are just not there. They can't make money because the cost for a new roof is twice what it was. And, all the materials into fixing up that home. And so, I don't want to like accuse them of like cutting corners. I don't think they're intentionally cutting corners. It's just kind of, it is what it is. Like, take it or leave it. If you want an older home and you want to get in under $200,000 and you want to get closer to that 1% rent to value, which I would love to address that. It's kind of driving me crazy, to be honest. But
we'll talk about it.
Yeah. So if you want to get closer to that 1% rent to value ratio, you can do that by buying one of these older homes that's, 100, 150, 200,000. But you're going to have some deferred maintenance and some capital expenditures coming up a lot sooner than you will on the new construction.
Yeah.
So, you got to choose your path.
Right. That's a good point. And one of the challenges that really makes people their own worst enemy, that makes them shoot themselves in the shoe, as you say.
To bring up that old audio.
Yeah, I know. If we really had a whole team of like editors, we would play that clip because it was so funny. And those of you who are old timers who've been listening for a long time, you know what we're talking about. It's a little inside joke there. But they have these expectations that are in the rear view mirror of a market that no longer exists. And it may never exist again. It might not exist again for 5 or 7 years. And if they wait, they're going to keep their money in savings and it's going to be obliterated by inflation. If they keep their money in the stock market, who knows what's going to happen, but it doesn't look good. I mean, I think we can all agree on that at the moment. And, it's always a question of comparing it to your other alternatives and simply choosing the best alternative. That's the way everything in life works. I know this is not as good as it used to be. I get it, but neither is anything else, right? So all you have to do is beat the other options. That's all you have to do. And then you're winning. You're winning the game. Maybe it doesn't have the performance you expected. It might in the future. It might next year. We don't know. But all you have to do is beat the other options out there. That's the goal. So
I've had
the 1%, tell us about that, Sara.
Well, 1% just means that $100,000 property is going to rent for $1,000 a month. That's 1% rent to value. And
but there isn't even $100,000 property anymore.
There is.
Barely exists.
There is, but you're not going to be in a desirable neighborhood. You're going to be attracting more of a, paycheck to paycheck tenant. You've got higher risk of maybe them defaulting, being able to afford their rent. You can still make money in those properties. I'm certain of it. They may come with more headaches. So it just depends. I've been working with Jason for 15 years and I've been watching his videos. I'm a little behind right now, but I've been attending the conferences. Anybody knows when we have our conferences, I sit in the back of the room and I really try not to let people pull me out of the room because I want to learn. And I really come to value the debt, the mortgage debt. It's a huge asset. And when you're starting out, it really doesn't feel like that. If you have the old school thinking, even people that have been doing this for a long time, they're still uncomfortable with debt. And I get it. I really do. But I've just seen the power of the leverage. And so if I can get a $300,000 property and I can get a bigger chunk of debt and still make that property perform, I know that if I fast forward in 5 years or 10 years, that property is going to way outperform the property with the $50,000 debt. And then I'm also going to have peace of mind because I'm not going to be dealing with all the challenges that come with older properties. I mean, I don't know. I mean, think of your own house when you have to call a contractor and you get a bad contractor and they take 3 months to finish a repair. And guys, we're living in a time where there are real labor force shortages. It's hard to get people to do work.
It's going to get worse and worse and worse. I mean, I've talked about on the show how the average construction worker now is 54 years old. That's insane. I mean, the construction job sites used to have a bunch of early 20s guys on them. And now, I mean, you just wait 30 years and it's the same people. You're right. And now they're 54.
I'm in the construction, my husband's in construction.
You're married to one of them.
Father-in-law, yeah. My father-in-law just retired and he's buying properties and he likes those cheaper properties because, he's comfortable with doing repairs because he's in construction. But yeah, I mean, he just retired in his early to mid 60s from, he had a desk job in the later years, but, my husband's, 40 plus and still doing the thing. So it's very true. But anyways, where were we going with all of that? Anyways, you have to ask yourself, like, what is the value of your time involvement? And so if you're looking for something a little more passive, I like the new construction, but if you want to be hands-on and deal with tenants and micromanage and deal with contractors, then go for the higher rent to value ratio.
And like I've said so many times, look, in the real estate world, you can make money in anything. There are a lot of different paths, right? You can make money in these war zone properties that are $100,000 and $80,000 and $60,000. People make money doing that. It's just a different business, right? It's not what our clients tend to like. It's not what we're into. We have in our network, we have quality properties in quality areas. You're just going to have most of the time a better experience. I mean, nothing's perfect by any means, but that's the thing. But going back to that 1% rule, right? Where people, they want to buy a $150,000 house and get $1,500 a month for it. As you go down in price, that ratio gets more favorable, but that's on paper. It doesn't really always work out that way in real life, okay? You don't have to get that 1% in order to beat other investment options, which is all you have to do. That's the only real goal here. Economics is a relative game. So if there's a recession and everybody is doing worse and everybody's getting a little poorer and the wealth effect is evaporating, hey, no one likes that, right? But as long as you're ahead of everybody else, then you're doing better, right? And the prices of all of the stuff you buy in the marketplace in your life, they ultimately adjust to the affordability of everyone else in the economy. So you get ahead. You've just got to go faster than others. That's the key. And that's all you have to do. And this is still far and away the best vehicle to do that with.
All I can think about is your bear story that you always tell.
It's not my story. That's an old story, but
I know, but it's a good example.
Yeah, it's the two people hiking in the woods, and one of them yells, "Oh, there's a bear coming at us! There's a bear coming at us!" And the other one bends over to tighten his shoelaces, and he says, "What are you doing, man? You can't outrun a bear." And he says, "I don't have to outrun the bear. I only have to outrun you." And that's the truth, right? That's the way economics work.
It kind of feels horrible, but it's true.
It is true. That's the way the economy works, right? You've just got to outrun the others, and then you're getting ahead as others are falling behind. So any other tips you want to share, Sara, before you go on, due diligence on the transactional part of the deal, or picking a market, or, diversifying your portfolio, or just anything else? I mean, you're talking to people about this all day, every day. So share some of that with our audience.
I would say, just get with your investment counselor and talk about what your plan is for, the year, the next 5 years. If you're somebody that's going to be deploying a lot of capital, you really want to think about, how many markets you're going to get into. We've all made the mistake of over diversifying. I think I was in like 7 markets at one time because, I did my investing kind of slow over time, and I just went where the next best deal was. And I think, Jason, you kind of started out that way, and then you got wise and you consolidated your markets. And so I would say, go into it with a plan. Your plan's going to change over time anyways, but try and maximize what you can do every year. And as far as like the actual transaction, our teams are pretty good about, walking you through. You definitely want to have that inspection. It's the most important thing, even on a new construction home, because things will come up. I have a client right now who, bought a new construction property. The tenant moved in and the oven doesn't work, and it's just been a hassle trying to deal with the warranty company and get that resolved. And, sometimes those things come up in the inspection reports, sometimes they don't. But if they do, you can add pressure to get them fixed before you close and before you put the tenant in place, So definitely don't skip that step. Let's see, appraisals, that's, done by the lender will order your appraisal. As far as insurance, I would
And
recommend.
any appraisal problems right now, Sarah?
We did just have one recently on, it was a fourplex, and I think it came in maybe 15 to 20,000 under.
That's kind of surprising that, well, maybe it's not, but the appraisers are always looking in the rear view mirror, right? And in a highly appreciating market, it's really difficult to get the appraisals to come in because they're always looking in the rear view mirror, right? And the market's changing so quickly. So it's a little bit surprising you're still seeing some appraisal problems occasionally.
Yeah, the thing is, a lot of these builders went through a lot of price increases. They had to drastically increase their prices because they were dealing with the material cost increase.
Mhm.
And I think it just all happened so quickly, and now things are slowing down a little bit and things are settling a little bit. And so I think for a while, nobody knew what the cost of a property was. Like, it was just, well, this one sold for that, so we're going to sell it for 20,000 more.
Right.
And, then we put on the brakes, and now we're kind of figuring out, where everything is. But the builder's working with the buyer on that appraisal. Maybe they'll meet in the middle somewhere, maybe they'll lower the price or give a concession to work that out. Whereas a year ago or 2 years ago, the builder would have said, take it or leave it.
Yeah, go pound sand
With
was
the
the
extra
answer.
20,000.
Yeah. Right. Exactly.
So,
what about the insurance? You were going to mention something about that.
I was just going to say, shop your insurance. We've got a lot of different insurance referrals we can share with you. Get 3 quotes, and we're going to have an insurance expert come out for our conference in Scottsdale to talk about, the different types of coverage and how to shop. So come to our conference.
Looking for that. Yeah. So Empowered Investor Live is coming up. Go to jasonhartman.com, grab your tickets for that. If they are still available, we're almost sold out. Definitely join us for that live event. And one of the things I said to someone yesterday about coming to our live or even our virtual events, rather than simply buying through the network, which is great, when you really know the provider in our network, our local market specialist, our property management teams, when they see your face, even if it's just on Zoom, if you're like a pro member or you come to a virtual event, live is the best, of course, but even if it's just a virtual event, you're going to have that bond with them, that relationship. And I think they're just going to go the extra mile for you to take better care of you. So really good idea to just get involved with us, either at live or virtual events. And I think you're just going to have a smoother experience. I mean, look, for most of you, this is your retirement plan. You certainly know that there's a pension crisis. You certainly know you can't depend on the government. Social Security, if it's there at all, it's going to be inflated away to where it has no value whatsoever. So none of us can depend on any of that stuff. And income property is really the only viable plan that really, really works for the vast majority of people. So get involved with us on that and go check out the event. And Sarah, thank you. Any closing thoughts you want to share, or let's wrap it up?
Yeah, I mean, just get involved. If you can't make it to the conference, join our Empowered Investor Pro membership. We do a Zoom every month, and our clients just love it because it's live and we can ask questions of each other. We can share experiences. Everybody always says to me, "Oh, I just took away that one nugget," and it just changed the course of their investment and really helped them out. So yeah, get involved. Call your investment counselor. This inflation, it's the real deal, and I'm feeling it more today than ever before. And I'm feeling it in my community, and mostly you're talking about retirement. In the elderly community, go on your Nextdoor app and see the cost of, just utilities and how the elderly are really struggling. So
it's devastating people. I mean, the cost of utilities, all forms of insurance, certainly health insurance, life is getting very expensive. And the only viable way to really insulate yourself is the income property, because the asset itself appreciates. And so that's a hedge against inflation. But through inflation-induced debt destruction, my trademark technique, your debt depreciates. And so you get wealthy 2 ways right there, plus all of the other benefits, tax benefits, cash flow, mortgage pay down, et cetera, income property, multidimensional asset class. So Yeah.
Yeah.
Got to protect yourself against that inflation. Sara, that is great advice. Thank you again for joining us. And folks, reach out to Sara if she's your investment counselor or the other investment counselors on our team. And we're here to help you build your portfolio and build your wealth. So thanks again for joining us, Sara.
Thanks, Jason. See you guys.